Higher bank fees aren't just annoying. They're a quiet way of paying you negative interest. If your fees went up this year, your bank is telling you something about your money, and it's not what you think. You felt it? $12 here for a maintenance fee, $4 for that out-of-network ATM. A surprise charge because your balance dipped below some magic number for one day. Meanwhile, groceries cost more, rent jumped, and your paycheck somehow buys less. You're thinking rates are high, banks should be doing fine, so why are you paying more just to hold your own money? Here's the part that links to your life right now. Those higher bank fees are not random. They decide whether your cash quietly grows or quietly leaks away. The reason is hidden in how banks make money and how they decide who they want as a customer. Imagine your checking account like a bucket with a tiny hole. You don't see water pouring out. It's just a steady drip. $12 a month, a few dollars for an ATM, a wire fee. That drip adds up to a puddle at your feet. The knowledge gap is this. You think fees are about covering costs. They're not. They're a pricing signal. And once you understand the signal, you can flip the game. Let's name the characters. There's you, trying to be smart with cash. There's your bank, which is not a charity. It's an engine with two fuel lines, interest and fees. And there's the world outside, where rates went up, fraud went up, and regulators started squinting at junk fees. Your experience: the monthly fee that used to be $10 becomes $12. The minimum balance to avoid it creeps from $1,000 to $1,500. The overdraft grace that saved you last year is now stricter. And that's where the real problem starts. You think you're losing $12? You might be losing hundreds. Here's the mechanism. Banks make money in two big ways. One, they take your deposits and lend them out at higher rates. The difference is their spread. Two, they charge fees on the account itself. Maintenance, ATM, wire, foreign transactions, overdrafts, paper statements. When the Federal Reserve raises rates, the bank earns more on loans. But there's a twist. Competition for your deposits suddenly matters. Money market funds start paying 5%. Online savings accounts offer 4 or more. People move cash. To keep their profits, large banks do something subtle. They don't raise rates for everyone. They keep checking accounts near zero, lift savings rates slowly, and then use fees and minimums to push you into patterns they like. Hold a bigger balance, use their debit card, bundle a credit card or a loan, or pay the toll. Wait, it gets stranger. For years, free checking wasn't free. It was subsidized by overdraft fees that used to be $30 or more, plus debit card interchange fees every time you swiped. Regulators and lawsuits squeezed those overdraft fees, so the subsidy shrank. Banks didn't absorb that hit, they reshaped it. That's why you're seeing more accounts with monthly charges unless you meet conditions. It's not punishment. It's a filter. If you're a low-balance saver who rarely swipes, you're unprofitable under the old model. The higher fee is the price tag that says, please change your behavior or move. Let's make it concrete. You keep $1,500 in checking because the bank says that avoids a $12 monthly fee. $12 sounds small, but that's $144 a year on $1,500 of idle cash. That's a negative yield of almost 10%. Meanwhile, a high-yield savings account could pay 4%. On the same $1,500, that's $60 earned instead of $144 lost. The swing is $204 on a small balance. Now scale that to $3,000 or $5,000, and you see the leak. Here's what nobody tells you. The monthly fee is the loud part. The opportunity cost is the silent part. Zoom out. ATM fees are not just about the machine. The operator charges a few dollars. Your bank often adds a few more. 2 out-of-network withdrawals a month at, say, $4 charged by the machine and $3 by your bank equals $14 monthly. That's $168 a year to access your own cash. Used correctly, that's a down payment on an emergency fund. Used lazily, it's a subscription for nothing. And yes, subscription is the right word. Banks know inertia is powerful. If you accept the fee once, you'll accept it again. But here's the twist that changed how I see this. A higher fee is not just revenue, it's a steering wheel. Fees nudge you to keep a bigger balance, set up direct deposit, or add products. The bank wants the customer that brings a paycheck, holds $5,000 in deposits, uses the credit card, and maybe gets a mortgage. That package is a gold mine. The customer with $300 in checking and no other products, under today's rules, they often lose the bank money, so the bank raises the toll on that lane. Remember that bucket? Let's meet Maya. She's careful, keeps $1,800 in checking to feel safe. Her bank pays almost zero interest. The account now charges $15 monthly unless she maintains $2,000. She is short by $200 for 3 days and gets hit with the fee. That's $180 a year. Maya also uses a convenient ATM near work twice a month, out of network, racking up another $168. Total leak, $348. What's her yield on the $1,800 cushion? Negative 19%. That's not a fee. That's a wrecking ball. And this is where things get interesting. Many people think, I can't move banks, I need a branch. But the branch isn't where your money grows. It's where you feel safe. Safety is good. Loyalty is fine. But if that loyalty costs you hundreds, it's a tax you chose. A simple 2-account setup beats the fee trap. Keep a thin operating account for bills and daily swipes, just enough to avoid overdrafts. Park your cushion in a high-yield savings or a treasury fund paying 4 to 5%. Automate a weekly transfer to refill checking. Use your bank account as a hallway, not a storage unit. Objection time. Won't my bank waive fees if I ask? Often, yes. Banks have retention budgets. If you've been a customer for years, they can reverse charges, waive 1 or 2 months, or switch you into a no-fee account quietly. But here's the catch. That's a bandage. The pricing model still sees you as unprofitable unless you meet their targets. Your goal isn't one refund. It's to stop being the customer that gets taxed by design. Another misconception? Fees went up because fraud went up, so it's fair. Fraud costs are real and rising. But fees don't scale with your risk. They scale with your behavior. That's the point. The bank charges for paper statements to push you digital. It charges for wire transfers to push you to their apps. It charges a low balance fee to push you to hold more cash. Whatever isn't aligned with their cost structure becomes a toll road. You decide which roads you drive. Let's zoom out deeper. There's competition banks don't talk about at the counter, treasuries you can buy in minutes, brokerage cash sweeps, fintechs that rebate ATM fees, credit unions that share a network of surcharge-free machines. When rates are high, these alternatives shine. When rates fall, big banks often cut savings rates first and leave fees alone. That spread becomes their cushion. Watch that pattern. It tells you when to move and when to negotiate. And wait, it gets stranger. The same bank that pays almost nothing on checking might offer a savings account paying a decent rate, but only if you link a debit card, set up one direct deposit, and keep a minimum you rarely need. That bundle looks like a reward. It's actually handcuffs. The direct deposit keeps your paycheck sticky. The minimum balance keeps your money lazy. The higher advertised rate pulls you in, but they count on you not moving the extra cash out when you don't need it there. Let's test a quick rule that flips the power back to you. Take every fee you pay in a year and divide it by your average balance. That's your personal interest rate, and it might be negative. If you pay $144 on $1,500, you're at negative 9.6%. If your savings earns 4% and your checking leaks negative 10, your blended return is your real result. The truth hits hard. The average saver often earns less on cash than the headline rates suggest, because fees quietly reverse the gains. What about renters juggling irregular paychecks, gig workers, or anyone who skates close to zero? The system hits them hardest. Overdrafts are rarer and cheaper than before, but the floor fee, maintenance, low balance, out of network, still bites. The counterintuitive move is to turn off overdraft entirely and use a prepaid debit or a separate no-fee online account for variable spending. You trade a little convenience for a lot of control, and control removes the tax of chaos. Remember Maya? She tried one change. She kept $300 in checking and moved $1,500 into a high-yield savings linked to the same app. She set every bill on autopay from checking and scheduled a weekly transfer of $100 in from savings. She chose an ATM within her bank's network, even if it meant walking one extra block. Result: zero maintenance fee, zero ATM fee, roughly $60 earned on the cushion. Her negative 19% flipped to positive. Same income, same city, different map. Here's what nobody tells you about higher bank fees. They are a message, not a fate. They say we prefer customers who do X, Y, and Z. You can do X, Y, and Z if it helps you, or you can take the hint and move. Big banks offer sign-up cash for a reason. Online banks offer higher rates for a reason. Credit unions offer community perks for a reason. Their models profit in different ways. Your job is to match your behavior to the model that pays you, not penalizes you. So, what do higher bank fees really mean for savers? 3 things. 1, they convert your checking balance into a negative return asset if you leave it bloated. 2, they reveal which customers your bank is courting and whether you're one of them. 3, they are levers you can avoid, negotiate, or rewire. Here's how you take the wheel this week. Calculate your personal interest rate, total annual fees divided by average balance. If it's negative, that's your priority to fix. Separate storage from spending. Keep a light checking account for bills and swipes, and move the rest to a high-yield savings, a treasury bill ladder, or a brokerage cash account that pays real interest. Set alerts for minimums and ATM usage, and turn off overdraft if it tempts you into fees. Ask for waivers, then ask for a different account type. If the answer is no, treat that as a market signal and switch. One afternoon of paperwork can be worth hundreds every year. Watch for 3 signals ahead. If rates fall and your bank slices your savings rate instantly while your fees stay the same, that's a red flag. If the minimum balance to waive fees creeps higher without better benefits, they're tightening the filter. If your bank bundles multiple products to make the fee go away, check whether the bundle lowers your total return or locks you in with fine print. Bundling is a trap when it makes you keep money where it earns less. You don't need a revolution. You need rules. Never pay a monthly maintenance fee. Never pay out-of-network ATM fees more than once a quarter. If you do, change your cash routine or switch to an account that reimburses. Never leave more in checking than you need for 1 to 2 weeks of bills. Every dollar above that gets a job somewhere that pays it. The revelation is simple and powerful. A higher bank fee is just negative interest printed in big letters. Once you see it, you can't unsee it. The relevance is obvious. This explains why your careful saving still feels like treading water, and the empowerment is yours now. You can move, you can negotiate, and you can design your account so the fees vanish and the yields show up. Banks will keep sending signals because that's how they optimize their business. You now read those signals, not as a nuisance, as information. When your bank says, hold more money here or pay the toll, you can smile, step to the open lane, and let your cash earn like it's supposed to. That's the part that turns an annoying fee into an advantage because you no longer pay it. You use it to choose better.